just now to talk to us more about China and its growth, or its slowdown, its hard landing or soft landing, and the effect and the impact of that on the resources sector. We have next a speaker that almost does not need an introduction. Jing Ulrich is Chairman and Managing Director of Global Markets China with JP Morgan. So with that, I'd like to introduce Jing Ulrich. Welcome.
Thank you. Thank you very much. Good morning, everyone. It's my pleasure to be here. Thank you very much for the opportunity. Today, I'm going to talk about China and China's demand for commodities. But before I begin, I'd like to just get a quick show of hands. I think there are several hundred people in the room. I wanted to ask people here who actually believes that China will have a hard landing. If you think China will have a hard landing, please raise your hands. No one? One? No one? So the rest of us believe China will have a soft landing? It's a binary question, okay? Binary answer is yes or no. So all of us believe China will have a soft landing. This is quite interesting. Actually, just about 2 weeks ago, I was traveling in the US, speaking to a very large audience, 600-700 people, and I raised the same question. As a matter of fact, one person raised his hand. He was the one person that believed in hard landing for China. And as soon as he saw he was the only person in the audience, he quickly put his hand down. So this is quite interesting. This is a big change from fourth quarter 2011 when I was traveling in Europe and the US. At that time, about 1/3 of my audiences believed China would have a hard landing. So just in the last 2 to 3 months, I think the concerns about the macroeconomy in China have somewhat dissipated. That is because we're seeing the central government changing its policy from fighting inflation to supporting growth. We are also seeing some small recovery in China's PMI indicator. We're even seeing the rather depressed housing market bottoming out. So the concerns about a hard landing seem to be dissipating. However, investors and companies around the world are beginning to think, are we going to have a profit hard landing? Even though the macroeconomy will do well, will all the sectors in the economy fare equally well? Perhaps not. Some of the industries in China are indeed struggling. This month, March, is a very important month for the Chinese corporate sector. Most of the companies are releasing earnings. Clearly, it's a very mixed picture. So we'll talk about, in this macro environment, which companies, which sectors, especially in the commodity industry, will fare well, which ones will not do so well. Throughout 2012, we see 3 main objectives by the central government in China. Number 1 is to engineer a soft landing. Number 2 is to preserve the progress China has achieved in containing inflation and containing house price escalation. And number 3, and most importantly, China is undergoing structural change of the economy, away from the dependence on exports and investments, more towards consumption. So I'm going to talk about these important objectives in the next 20 minutes. Hopefully we can leave 5 to 10 minutes for questions and answers. Now, let's first take a look at the overall structure of the Chinese economy, where the GDP growth is actually coming from. So there are 3 lines on this graph. From the bottom to the top, you have net exports, consumption, and gross capital formation. So you can see the line at the bottom, which is net exports, is no longer contributing to growth. Actually, in 2011, we had 9% growth, but net exports were a negative 0.5% contributor to GDP. That means all the growth we're seeing from China today comes from internal sources, which are the 2 lines on the top, consumption and gross capital formation. Now, growth capital formation, sometimes we say fixed asset investments. That's basically investing in manufacturing, in factories and plants, in infrastructure, housing, etc. So that's the most important driver for China's overall growth. As you can see, that's a line on top. So most of the growth in 2011 came from growth capital formation. Consumption is quite steady. It is picking up. However, the contribution from consumption is still lagging that of growth capital formation. So if there's any silver lining during the financial crisis in 2008, 2009, that is basically China's dependence on net exports to drive growth has diminished. So in a way, one part of China's rebalancing has already taken place, which is rebalancing away from external demand to internal consumption. But within China itself, within the domestic economy, growth is still quite reliant on fixed asset investments. Consumption's share needs to pick up. Now, for people here in this audience, since you're involved in resources and commodities, the most important driver for your business will be fixed asset investments. Now, fixed asset investments obviously has many different components. I just show you the three most important components. Number one is manufacturing. It's around 1/3. Number two, property, 20%. Number three, transportation, 9%. Now, looking at the three most important components of fixed asset investments in 2012, the growth rate compared to the last 2 years will clearly be slower. Manufacturing, we know, because the export sector is not doing too well, external demand remains quite sluggish. So export-oriented manufacturing this year perhaps will show only very modest growth. So that perhaps could be half of manufacturing. In terms of real estate, on paper, it's 20% of China's fixed asset investments. By the way, fixed asset investment is 50% of China's GDP. So that gives real estate about a 10% share in China's GDP. However, I would say the importance of real estate to the overall economy is much more important than what's stated in a 10% figure. It could be as much as 20%, because as you know, the property sector has some 60 related industries, from basic materials to home appliances, et cetera, et cetera. So therefore, the share of real estate is actually much higher than the stated number of 10% of GDP. Now we know the real estate sector is in a downturn and has been a downturn in the last 14 months. We had a policy introduced back in January 2011 from the central government restricting home purchases because home prices had gone up so much in the prior 10 years. It basically became unaffordable for the average household in China. Also, there were a lot of speculative activity and investment activity in the housing market, which made the housing market a social issue because lower-income families couldn't afford housing and home prices had gone up so much. It really increased social tension. So as a result, 14 months ago, the central government put on a series of measures to contain home speculation. So since then, we have seen home prices falling, especially in the last 5 to 6 months. Every single month, the average home price in China has been on a downward trend. And importantly, transaction volumes across the first-tier cities in China have gone down a lot, by as much as 30, 40 to 50%. Now, what's important for you is what's going to happen going forward. Will construction activity slow because of the slowing activity in the housing market? Well, we have to look at this as two separate issues. If you're a home developer, a property builder in China, perhaps the worst is behind you already, because the last 14 months have been quite challenging. However, we're beginning to see transaction volumes recover. When I visit third-tier cities in China, second-tier cities in China, I see local governments very keen to support the property market because, after all, the local governments rely on land sales for their fiscal revenue. And the central government is also very keen to support first-time home buyers, especially among the lower income families in the lower end of the housing market. So banks in the last 2 months have begun to disperse loans to first-time home buyers and even offering a discount on the mortgage rate based on the benchmark lending rate of 10% or 15% discount. So the home prices, although are still on a slightly downward trend, transaction volumes have begun to recover just in the last couple of weeks. So property developers that are focusing on the mass end of the market will fare okay. But if you're only building villas, there's no market for you, I'm sorry. However, if you are a construction company or if you're a building material supplier to the housing sector, the worst is not yet behind you. The reason is that because of the last year's sluggish performance in the housing market, we have a lot of inventory. We have about 12 to 14 months of inventory of unsold properties on the market. So even though transaction volumes are recovering, you have so much inventory, you're not going to build anything new until the existing inventory is sold. So in the first half of 2012, building materials companies, cement, steel, aluminum, will not fare too well because we have a glut of inventory on the market. But if you're a property developer, you make money from selling properties rather than building the homes. I think the worst perhaps is behind us already. Now, having said all that, we do believe, at least in the first half of 2012, the construction activity will actually be quite slow. So therefore, the contribution from the real estate sector and the construction sector overall to the economy will be quite sluggish. Finally, you have transportation. Transportation obviously is very broad. That includes railways, highways, local light rail projects, and so forth. Here is a mixed picture. We all know about the disaster back in 2011 in the high-speed rail sector. That, of course, derailed China's high-speed rail spending program. This year, based on last year's very low base, railway spending actually will pick up to about 400 billion RMB, which is quite a substantial amount. You divide by that 6, you get a US dollar figure. It's about 70 billion US dollars, which is quite substantial. So the railway program will go ahead. Some of the local government's funded projects are slowing down and stalling. When I visited some of the third-tier cities in China, I saw local government's finances coming under quite a lot of difficulty due to slowing land sales. So some of the locally funded projects, light rail, subways, are basically being stopped or slowed down due to the lack of finances at the local level. So overall, the picture is quite clear. Fixed asset investments, 50% of GDP, the 3 most important components of FAI, i.e. manufacturing, real estate, and transportation, will all show a degree of slowdown in 2012, at least in the first half. So therefore, the contribution from fixed asset investments to GDP will slow down. Last year, FAI grew 23.9%. This year, we project FAI growth to be around 16 to 17%. The government's projection is 16%. So therefore, the contribution from FAI to overall GDP growth will be a notch lower. Now, in view of the deceleration of the economy, what are the government policies for the rest of this year? Number one, as I said, we changed the focus away from fighting inflation to supporting growth. So we will have monetary easing. We will also have the support of smaller enterprises. In China, large companies tend to be favored by large banks in terms of credit extension. Small companies tend to pay much higher interest, and it's very difficult for them to obtain loans. The central government is making a concerted effort to support smaller enterprises. Income growth, this is for households. Of course, we have income growth ranging from 15 to 20%, especially among the manufacturing workers. We also have tax reduction to support disposable household income growth. And then strategic industries, basically clean energy, high-tech services, are going to be supported by the central government. Fifth, we have tax reforms being unveiled in Beijing. Basically, we have tax reductions across a whole host of industries, which I will highlight later, to support economic growth. And finally, consumption incentives. Perhaps we have a reduction in consumption tax in China that will help stimulate the purchase of certain types of high-end goods in China, especially luxury goods, cosmetics, and so forth. So overall, if you look at, put the pieces of the puzzle together, the central government clearly has shifted its focus from combating inflation to supporting growth. And throughout 2012, we expect a series of measures to come out of Beijing to support economic development. Now, I will highlight some of the key issues that I just mentioned in terms of monetary easing. So monetary easing, people in the West tend to think about interest rate cuts. In China, first and foremost, you have to look at credit extension. How much liquidity, how much money, how many loans are available in the economy. That's much more important than the cost of money. So the availability of capital is more important than the cost of capital in China. And you can see this line here from it's 2006 to last month, 2012. This line shows you China's overall credit growth. So during 2006 to 2008, before the financial crisis, loan growth or credit growth was around 15 to 16% per annum. That was reasonably normal because GDP growth nominally during those years was around 15%. So that was in line with loan growth. However, in 2009, we had the 4 trillion yuan economic stimulus program, and loan growth, as you can see, spiked up to about 35% at one point. And that was, of course, excessive. In hindsight, we now realize the downside of that stimulus program, which, of course, resulted in inflation, overheating, overinvestments. So in 2010, the central government basically began curtailing credit growth. You can see from a high of 35% growth, loan growth has actually come down to the historical range. Last data point, I think, was about 15% growth. So loan growth has clearly come down to the historical norm. Now, the banks are, these days in China, extremely profitable. The Chinese banking sector is the single most profitable banking sector in the world. The leading Chinese banks, the state-owned banks, are among the most profitable banks and the most profitable companies in the world. Some of them make more money than Apple. Really quite remarkable. Now, the problem is that these days, because of negative real rates for consumers, for depositors, a lot of people are finding other ways to deposit their money. So deposit growth has been quite sluggish. That constrains the bank's ability to lend. So when I talk to bankers these days on the mainland, they always tell me they're fighting very hard to win corporate deposits and household deposits. Altogether, in the Chinese banking system, we have 81 trillion yuan of total deposits. Again, divide that by 6, it's a huge amount. GDP is 45 trillion RMB, so you can do the math. So deposits in the banking system are around 180% or 190% of China's GDP. Okay, so Chinese banks, of course, face a lot of challenges, but they will not go bankrupt. Okay, you have a very nice, solid cushion called deposits. Okay, the deposits are huge, and the deposits have really nowhere to go because we have capital control in China. So the challenge facing Chinese banks basically is how to serve the real economy better. There are some concerns in China because banks are making a lot of money, but the real economy companies, in the auto industry or in the metal sector or in the consumer sector who borrow money from the banks are not making a lot of money. Banks have protected margins. Their interest spread basically contributes to these high levels of profitability. So there is a bit of a disconnect between the banking sector and the bank's customers, which borrow money from the banks. Financing cost is up, banks' profits are up, but the profitability of the real economy companies has been suffering. So throughout this year, 2012, we will see steady credit growth, nothing like what we saw in 2009. Even though the economy has become, even though the government has become pro-growth, they are going to be quite prudent. They don't want to repeat what happened in 2009. They want to see steady credit growth. So we're expecting about 8.2 trillion yuan in new credit in the whole banking system. Last year was 7.48. So there's growth based on last year's figure. And it's important to point out that the overall liquidity in the economy is sufficient to support China's overall economic growth. Now, speaking of monetary policy, we have to look at the reserve requirement ratio. Again, this is a more important tool than interest rates in China. So the reserve requirement ratio is very simple. What it is basically if you have a 1 yuan, you have a 100 yuan deposit at the banks basically have to freeze up to 20.5% in the form of reserves. You cannot lend that money out. The ratio for big banks is 20.5%. For smaller banks, it's 18.5% today. We had 2 cuts in the reserve ratio already. Each cut of 50 basis points basically releases 400 billion yuan into the financial system. This morning, if you're reading the paper or listening to the news, you will see that China just cut the reserve ratio by 2 percentage points for several hundred branches of the Agricultural Bank of China. Why so specific? It's March. Spring is coming. That means planting season is starting. So China wants to support the rural industry and farmers by making more credit available. So therefore, this morning, selectively, in a very targeted way, they lowered the reserve requirement ratio for several hundred branches of the Agricultural Bank of China. So this is a very important tool for China to use to make more credit available in the economy. Now, I think this year, 2012, after the 2 cuts we saw in the last several months, we will see 3 more cuts in the reserve ratio. There's a lot of money frozen in the form of reserves. Okay, I mentioned we have 81 trillion yuan in deposits. You can do the simple math. 20% of 80 trillion is what? 16 trillion. It's a lot of money. I said GDP is 45 trillion. You can divide 16 by 45. You come up with a ratio. 40% of GDP is frozen in the form of reserves. What this means is that China has deep financial resources to deploy should the economy slow further. They can cut the reserve ratio multiple times to unleash more liquidity into the economy. 40% of GDP is still frozen in the form of reserves. They can cut that. You know, back a few years ago, the reserve ratio was 7%. It's tripled since then. If the economy did slow down too sharply, they could cut the reserve ratio much more aggressively. So there's no need to worry about the economy slowing too fast because the central government, the central bank, financial regulators do have the tools to inject liquidity. Now, let's take a look at tax. I mentioned monetary policy. Let's take a look at fiscal policy. This year, to support China's rebalancing, we will have more reduction in personal income tax. So what they do is they lift the threshold based on which you have to pay taxes. Last year in October, the central government lifted the threshold of annual income on which people have to pay taxes. So basically, that resulted in a tax cut for millions of people. Actually, 65 million people after that reduction no longer have to pay any income tax. So this really helps lower income families. Consumption tax, I mentioned, this is quite complicated, of course. You know, consumption tax is levied across 5,000 types of goods. But recently, there's a lot of talk among luxury goods retailers in China because luxury goods in China onshore in the mainland are much more expensive than Hong Kong, Europe, or the US because of taxes. So China could consider cutting consumption tax to make the price gap smaller. That will induce more buying on the mainland China instead of having all the people coming to Hong Kong to do their weekend shopping. So this is another way to support consumption. VAT is important. What this is that in China, there's something called the business tax. Business tax is a turnover tax. it is taken straight off your revenue. And this is for the service industry. So if you are a logistics company, for example, you used to have to pay 5% straight off your turnover line. That's quite punishing, quite high. Now, starting this year, the central government began a pilot program in Shanghai converting the business tax into a VAT, which basically will result in a tax cut for the service industry. I was in Beijing on the weekend, heard the Minister of Finance address a conference I was attending. The Minister of Finance said, we will roll out this pilot program from Shanghai to other cities, including Beijing, including Jiangsu province, and other cities, because this will help support industries in the service sector, logistics, retail, and so forth. And finally, resource taxes. This is quite important because all of you are involved in resources and commodities. In China, this resource tax is relatively new. It now is nationwide. So what this means is that if you are an oil exploration company, or if you extract natural gas, or if you mine coal across China, the company has to pay resource taxes now to the local governments. For example, PetroChina may have gas or oil production in Xinjiang out in the northwest. So from now, PetroChina would have to pay resource taxes to that province. This basically is a way to bolster the finances of local governments. As I said earlier, local governments' financial position is under threat because of lack of land sales. The central government now wants to support local governments' fiscal position by imposing this resource tax on the resource companies, which then pay the taxes to the provinces where the resources are extracted. So this is a way of balancing revenue from, between the central government and the local governments. Now, I want to say a few words about housing. I already said this year we will see a slowdown in China's construction activity or new starts. Here's a graph. This graph shows you China's residential new starts, shows year-on-year growth. One line beginning January 2010 to February 2012. So you can see January of 2010, we had 80% growth in new construction starts. That's not surprising because we came from a very depressed place in January 2009, so the year-on-year growth was quite exaggerated. Since then, that new starts growth rate has come down. Every year you have that dip. That's because of the Chinese New Year distortion. But you can see as of the last month, construction starts are not really growing. Actually, briefly in the fourth quarter of 2011 and January, new starts actually showed negative growth. So this is a phenomenon I described earlier. You have so much inventory on the market. Developers are cash-strapped. They're conserving cash rather than spending their money. They want to sell existing inventory before they build new ones. Now, importantly, the offset to this is basically the low-cost housing program. China has the ambitious goal of building 35 million units of low-cost housing between 2011 and 2015 during the 12th five-year plan. That's a lot, 35 million. Every time I go to Canada, the Canadians will tell me that's a home for every man, woman, and child in Canada. Well, China's population is a lot larger, right, by 1.3 billion people. But even for 1.3 billion people, we have 300 million households. 300 million households, if you build 35 million units of low-cost housing, that means over 10% of the households will be entitled to low-cost housing by the end of 2015. That's substantial. So the high-end construction activity will slow. No one is allowed to buy villas, so don't build more villas. But at the lower end, ordinary housing or affordable housing supported by the government will have really great demand because people's incomes are in line with the cost of these lower end properties. So therefore, low-cost housing construction will help take up some of the slack in the slowdown in the high-end housing market. But in 2012, it's not going to be offsetted completely. So therefore, we are going to see relatively slow new construction, at least in the first half of this year. And that is going to affect some of the raw materials, of course. A few quick words about commodities. This graph shows you China's coal imports. Chinese coal imports have been rising, as you can see. From 2009, China became a net importer of coal for the very first time. 2011, China became a larger coal importer than Japan, #1 in the world. Even year to date, coal imports continue to increase. The country produces 4 billion tons of coal, but it imports over 100 million tons, 150 million tons, I should say, mainly along the coastal region. So if you're a coal supplier to China from Indonesia, from Australia, from Vietnam, I think you still have a very good market given the transportation difficulties within inland China. And then a few words about copper. This graph shows you Chinese copper imports annually. You can see the three tallest blue bars, basically 2009, 2010, 2011. Those 3 years, Chinese copper imports went above 3.5 million tons. Of course, China is the single largest copper consumer in the world. The country consumes, I don't know, this year probably 8.7 million tons of copper. That's 40% of global copper production. I think global copper production is probably 80 million tons, maybe slightly less. China is the single most important buyer of copper. 50% of the copper used in China is imported, so these numbers all match up. And the orange bar shows you January to February copper imports. They're up. They're up because last year, second half 2011, copper imports decelerated remarkably. In the first 2 months of this year, perhaps destocking has taken place. China is back in the market buying copper. I think this is provides good support for copper prices. No wonder copper prices have recovered a long way from the financial crisis, and it has been one of the best performing commodities in the last 2.5 years. I think copper prices are still around, what, $8,500 per ton. Off the peak, but not so far from it. We are projecting copper prices to be hovering around this level, probably around possibly reaching $9,000 per ton sometime during 2012. Iron ore, I know there's some iron ore producers here or aspiring iron ore producers here. In the audience, iron ore imports are equally breathtaking. You can see the last 3 years, 2009, 2010, 2011, iron ore imports continue to increase. Year to date, iron ore imports are up about 5%. The steel industry is struggling. Most of the steel companies are loss-making because, relatively speaking, raw material prices are still higher than the actual steel output prices. Steel companies can't make any money. I mean, they have high energy cost, high imported raw material costs. Coking coal prices have come down, but they remain quite elevated. And we have overcapacity problems in the steel industry. So midstream industries in China, whether it's aluminum smelting or steel making, continue to struggle. But if you're a raw material supplier to China in areas where China is deficient, such as copper, such as coking coal, and to a degree, iron ore, you're still going to be quite well positioned. Now, let me just wrap up with a few concluding remarks. During my talk, I mentioned in 2012, the central government will deploy a range of policy to support economic growth. They will use monetary policy, fiscal policy, but remember, fiscal policy will no longer be a very blunt tool to regulate the economy. They will be very prudent, but if the economy slows down more sharply, more policies will be on the cards. Looking at the 3 most important objectives for the central government in China, #1 is to engineer a soft landing. #2 is to preserve the progress in containing inflation and home prices. And #3, most importantly, is to achieve economic rebalancing internally within China. Now, of course, we think the economy is on track to achieve a soft landing. Not all sectors of the economy will be able to sail through the current year and the next year with no difficulty. Of course, sectorally, the performance will be quite uneven. However, if you're a raw material supplier to China, you have good reserves, you have low-cost production, you're supplying into a very robust Chinese economy, I think you'll be very well positioned. Thank you very much. Do I have time for questions?
Jing, thank you so much. I'm afraid we're a little bit over time, so there's no time for questions.
No problem.
But we'd really like to thank you for a very, very insightful presentation. Ladies and gentlemen, please join me in thanking Jing Ulrich from JP Morgan.
Thank you. Yeah.
Thank you.
All the best to you. Enjoy the rest of the conference. Thank you for having me.
We're going to move on now. Our next speaker will come up straight away. We're going to focus on leveraging China's development bank's resources to support outbound investment. So we have CDB International here with us, specifically Ms.